This is a picture of me when I was in college with a net worth of exactly $0. And just like many young teenagers, I thought that I was going to start an online business, primarily Amazon FBA, generate a shit ton of passive income, and then eventually retire and use that passive income to fund my retirement. But the reality is that I ended up losing $7,000 trying to start an Amazon FBA business. Luckily, I wasn't so bold to just drop out of college and pursue those passive income dreams. And instead, I got a job in the Bay Area as a software engineer right out of college. I've been able to grow my net worth from $0, as you saw in that picture, to now today being closer to around the $750,000 mark. In this video, I'm going to share 3 of my most practical, important steps that you need to take if you want to become a millionaire by the time you're 29. Now, the first step, and undeniably the most important step in this entire 3-step process, is to increase your savings rate. The number one factor to you reaching your financial goals and ultimately gaining financial freedom is to increase your savings rate. Put simply, your savings rate is how much you can save in a given month after you deduct all your expenses. Now, the first thing you have to understand about increasing your savings rate is that most people tend to focus on decreasing their expenses rather than trying to figure out how to increase their income. And generally speaking, increasing your income is going to be the more effective and more efficient way in growing your net worth over time. The very first step I would take if you don't know what your savings rate is to first track exactly what your savings rate is. So what my wife and I do is that we have an app called Mint, and this is not a sponsored video, and Mint is basically a budgeting app, but for the most part, we input all of our financial accounts into Mint, like our credit cards, our bank accounts, our mortgages, and essentially what we do is every month we review the monthly spending on Mint. And so we'll calculate how much we spent in a given month, which categories we're spending the most in, and then we compare that with how much income we brought in that month. So we don't really go by percentages. I think it's just simpler just to say that we want to save $5,000 rather than saying like we want to save like 60% of our income. Now, the importance of knowing what your savings rate is that you can start to determine how fast you're going to be able to reach your net worth goals or your financial goals. So now that you know what your savings rate is, you now have to determine, am I on track to reach my financial goals? And if you're not, then the first question you need to be asking yourself is, how can I increase my income so that I can ultimately increase my savings rate? So let's talk about income for a split second. What I would suggest and what I'm planning on doing in 2023 is focusing heavily on the W-2 income, and here's why. The very first reason is that you can start a business on the side of having a W-2. That's why we call it a side hustle. The reason why I think everyone should start with finding a W-2 job that pays well is because you can leverage the flexibility from that 9-to-5 job to start side hustles. You can use money from the W-2 and you can use it to fund your side hustles. The W-2 job allowed me to first fund those businesses to begin with, but more importantly, it allowed me to recover from failures and start a new business right away. And eventually, one of my businesses ended up doubling my net worth in just 1 year. Without my W-2 job, after that first failure, I wouldn't have been able to start a second business or even a third business because I would have run out of funds. So in summary, the W-2 really provides me 2 things. The first one is a comfortable life while I'm building my side hustles. Now, the second and more important thing, in my opinion, that it allows me to do is it allows me to start these businesses without fear of failure, because even if I lose $2,000-$3,000, that's okay because I'm going to be making that money back from my W-2 job in maybe 2-3 weeks. And hopefully one of those businesses will catch just like it did for me, and you will be able to apply all of the learnings from your past failed businesses to create a successful business that can eventually overtake the income from your W-2 job so that eventually you can leave that W-2 job. That's the goal, right? So now the last thing I'm gonna mention about increasing your income is which job should you get? Now, obviously I am biased. I am a software engineer, so obviously I'm gonna tell you to become a software engineer. If you really think about it, the 2 things that really matter to me the most is number 1, high pay, but also number 2, flexibility. Because if you think about what I've been saying, the whole point is to get paid well so that you can save every month and feed that into starting side hustles. But then number 2, you need that flexibility, otherwise you're not gonna have time to build those side hustles. This is why I would never suggest becoming, like, for example, an investment banker, because although you do make good money, you don't have the flexibility or the time because you're working 80 hours a week, in your job. And so you don't have enough flexibility to start side hustles. And if you can't start side hustles that can eventually overtake your income, then you're going to be stuck at that job for a very, very long time. So again, step one is to increase your savings rate. And again, the most efficient way to do that is to focus less on reducing expenses and rather increasing your income. Now let's talk about step two. Now, assuming you have a relatively high paying job with good flexibility and you're saving a good amount each month, the next step for you is to invest your savings into assets that help you pay less taxes. The thing that kills me, especially for high paid individuals or single filers, is that they don't realize how much taxes they're really paying to the IRS. And the second thing that they don't realize is that they don't actually have to pay those taxes if they invest in the right assets. Now, if you didn't know this already, real estate is by far the best asset that you can invest in to help you pay less taxes. So my wife and I bought about $1.8 million worth of real estate in 22, and between the two properties that we bought, we were going to be paying about $80,000 less in federal income tax in 2022. This is the power of investing in real estate. So now I'm going to go a little bit more into depth about how my wife and I are saving $80,000 in federal income tax in 2022. And I want you to think about how fast your net worth would be growing if you're paying $80,000 less in federal income tax every single year because you're using the strategy. So let me dive a little bit deeper into the strategy that my wife and I are using for 2022 to basically pay $80,000 less in federal income tax. So the strategy starts by obviously buying real estate. So we bought two properties in California, the first one for $960,000 and the second one for $900,000. The second step is that we did something called a cost segregation study. So a cost segregation study is basically when it's a third-party service, and basically what they'll do is they'll come out to your property and they'll take a look at your property, and they're gonna break down all of the components that make up your house into multiple categories. And the categories are based on useful life. So they're gonna look at your fridge and say that's a useful life of 5 years. They're gonna look at the floors in your house and say that's a useful life of 15 years. And then at the end of this report, they're gonna give you basically a PDF file that basically says, here's the value of all of the components in your house that have a useful life of 20 years or less. So again, we had two properties. For the very first property, we did a cost segregation study. It cost us about $640 to do the study. And basically the study spit out that we were going to be able to take a deduction of $160,000 for that property in 2022. Now for the second property, again, $640 for the study, and it came back for $210,000 of deductions for that property in the first year that I owned it in 2022. When you buy rental properties, what you're doing is you're basically starting a rental business. So you're in the business of renting homes. So in my business, between those two homes, I brought in, let's say, $60,000 worth of rental income. But between the $160,000 deduction plus the $210,000 deduction, that's $370,000 worth of deductions, but only $60,000 worth of income. That means that on paper, my business lost about $310,000. Let me back up a little bit. Why is it that we're able to take a $160,000 and a $210,000 deduction in our business? The answer is because of a concept called bonus depreciation. And essentially what bonus depreciation allows us to do as real estate investors is to take all of the components that are contained within a home that have a useful life of 20 years or less and take a full deduction for the value of those components in the first year that we own the home. So again, for the first property, it was about $160,000 worth of items that had a useful life of less than 20 years. And then for the second home, there was about $200,000 worth of components in that home that had a useful life of less than 20 years. So that's why we're able to take those deductions only the first year that we owned that home. So only in 2022 and not in 2023. Now, the thing you have to understand about this bonus depreciation concept is that it's what we call a phantom loss, and it's one of the main reasons why I invest in real estate. The thing you have to understand about the power of a phantom deduction is that a normal deduction means that you spend $300 on a camera for your business and you get a $300 deduction, right? But the thing is, you're still $300 less out of cash. But when it comes to a phantom deduction, what it means is that you didn't actually spend any cash to get that deduction. So that is true for depreciation. And the reason why it's true is because you're not spending any money and yet you get this humongous, $160,000 or $210,000 deduction. And ultimately the goal of having this large negative passive loss is to ultimately take that loss and apply it directly against the income that my wife and I produce from our W-2 and 1099 jobs. Now in 2022, if we report to the IRS that we made $410,000 as a married couple, our federal income tax burden for that year is close to $100,000. Now, on the flip side, if we as a married couple report that we only made $100,000 to the IRS, then we would only pay about $17,000 in federal income tax. Now, the difference between those two numbers is about $83,000. And essentially, this is how we are planning on saving about $80,000 in federal income tax in 2022. We are using bonus depreciation to get a humongous deduction for both our rental properties so that on paper, our rental property business is operating at a very, very large passive loss for 2022. And we can use those losses and carry them across the board to our W-2 income and reduce our adjusted gross income for 2022. Now, before you go buy real estate, you have to understand two things in order to be able to do this. So the very first thing you have to understand about the strategy is that in the eyes of the IRS, there's actually two types of income. There's passive income and then non-passive income or active income. And in the case of any business, a business can be either a non-passive activity or it can be a passive activity. But in the case of rental properties, they're usually passive businesses, meaning they produce passive income and they produce passive losses or passive deductions. So again, in our case, our two properties brought in about $60,000 of passive income and produced about $370,000 of passive losses. Now on the flip side, your W-2 income and your 1099 income is considered as non-passive income or ordinary income or active income. And the very first thing you have to understand is that you can normally not mix passive income or passive losses with active income or active losses. So normally, even if you were to do this cost segregation on both your properties and generate this ginormous $310,000 passive loss, well, you're actually not able to write off any of that against your W-2 income. Now, this gets me to my second point. One of the only ways that you can use passive losses, in this case, the $310,000 of passive losses from my rental property business, against non-passive income from my W-2 job and from my wife's 1099 is if you have something called real estate professional status. Now, in order to qualify as a real estate professional, you can go to the IRS website to see the full qualifications on how to become a real estate professional, but simply put, you need to be working in a real estate related field full time, and it needs to be working in that field more than any other job. Now, if you or your spouse are a real estate professional and you're filing jointly, then as part of that tax return, you can use the real estate professional status to your benefit. Now, to wrap things all up, if you or your spouse qualify as real estate professional, there's one last thing you need to do in order to take this passive loss and apply it directly against your non-passive income, and that is called material participation. And material participation just means that you or your spouse are materially participating in the rental activities regarding those two rental properties. So we basically are self-managing those two rental properties, and now that we meet the requirements of real estate professional status and material participation, we can now take those ginormous passive losses from our rental properties and now use it against the non-passive income that we produce from our W-2 and our 1099. Now, if you're thinking, wait, I'm single, I'm working a W-2 job, I can't qualify for a real estate professional, or I'm married but neither of us are real estate professionals, That's okay, because there actually is a second option to this besides having real estate professional status. It's called the short-term rental loophole. And basically this strategy allows you to basically forget about real estate professional status and allows you to still take losses from your business and apply them directly against your W-2 or 1099 income. I'm not going to go into the details of the short-term rental loophole in this video, but if you guys want to learn more about that, then subscribe and I'll make another video about that. So now, with a combination of buying rental properties, doing a cost segregation report on them, taking bonus depreciation against those properties, and then using real estate professional status or the short-term rental loophole method, you can take those large bonus depreciation deductions directly against your W-2 or 1099 income. Now, I hope you guys understand the importance of this second step, right? Essentially, my wife and I are saving $80,000 that we would have been paying to the IRS that we are no longer paying to the IRS, and instead we're using that money to go buy more rental properties. You can see how this could impact your net worth over the next 5 years. Not to mention, the rental properties that we are buying will eventually appreciate over time, and the tenants that we have in place are paying down the loan for us over the course of the next 30 years. So that brings us to step 3 and the final step, which is to take your tax savings. In this case, for us, it's about $80,000, and reinvest. So now that my wife and I have saved about $80,000 in 2022, we can now use those $80,000 to go buy more rental properties. And you guessed it, we're gonna be doing another cost segregation and taking bonus depreciation against that property in 2023 this year. So now that you've listened to this entire video, you might be thinking to yourself, like, this is too good to be true. What is the catch? And there is a catch, and it's called depreciation recapture. Let's take it back to the first property that I bought. Remember, it's a $960,000 property, and in 2022, I'm taking a $160,000 deduction in the name of bonus depreciation the first year that I bought it, so in 2022. Now, if I were to go sell that property in 2023 this year, what will happen is that the IRS will say, hey, remember that $160,000 of depreciation deductions that you took last year? Well, you're selling this asset and we want you to report that $160,000 as income the year that you sell this asset. So in 2023, if your adjusted gross income was about $400,000 and you sell that asset, you're gonna have to report back all of that depreciation that you took, the total sum of $160,000, to your AGI in 2023. So your AGI would go from $400,000 to $560,000, and you're now going to owe a lot more taxes for 2023. Now, one way you can avoid depreciation recapture is obviously to never sell. You can refinance as many times as you want, or you can pull out a HELOC as many times as you want to access the equity in your properties. But as long as you never sell, you're never going to be hit with depreciation recapture. And then another way to avoid depreciation recapture is, instead of selling your rental properties, you do what's called a 1031 exchange, where essentially you're not really selling the property, but instead you're exchanging for a like-kinded property. So you can think of it as trading for a bigger property. And there are actually a few more strategies on how to eliminate depreciation recapture, but for the sake of simplicity, I'm not going to go into those. Those will be in another video. So in summary, this is how I plan to become a millionaire by the age of 29. Firstly, I'm going to continue to grow my income at my W-2 job. Secondly, I'm going to leverage the flexibility from my 9-to-5 job to start side hustles that can eventually overtake my W-2 income. Thirdly, I'm going to take the savings from my W-2 job and my wife's 1099 job, and we're going to invest into assets that help us pay less taxes. The fourth step is utilize cost segregation and take bonus depreciation deductions in order to help us pay less taxes on our W-2 income. And then the fifth step is obviously to take those tax savings and invest it into more real estate that's going to give us even more tax write-offs. And then I guess you can include the last step, which is basically repeat this process over and over, year after year, and eventually you're going to be able to grow your net worth to a very considerable amount. So that's it for this video, guys. That is how I plan on becoming a millionaire by the age of 29. If you guys have any questions, feel free to schedule a consultation with me. I call it a strategy call. You can talk to me for 30 minutes or an hour. The link is in the description. Thank you so much for watching, guys. And if you guys want to keep up with what I'm doing in 2023 to increase my net worth even more, then stay tuned and be on the lookout for the next video. See you guys.